It's 10 a.m. in London, 5 a.m. in New York, 5 p.m. in Hong Kong. Our top stories today. More fresh data trickles in as ECB officials ponder whether to hike or hold next week. Europe services data was weaker than forecast, while consumer inflation expectations inched up. Meanwhile, in China, disappointing data adds to concerns for the country's recovery. Bloomberg Economics says China may never overtake the U.S. as the world's biggest economy. And Goldman Sachs gaining confidence in the U.S. The bank now sees a 15% chance the U.S. will slide into recession, down from 20%. Welcome to Bloomberg Surveillance. You're watching the early edition. I am Dani Berger in London. Sonali Basak is in New York. Sonali, we've had a lot of European data trickle in this morning. More breaking just now. Euro area July producer prices fall 7.6% year over year. That is bang in line with estimates. However, the month-over-month figure is slightly less of a fall than expected. 0.5%. The estimate was for 0.6%. Yet another set of data that shows inflation maybe not coming down as much as expected, while there's still those growth concerns rife. But how's the U.S. looking, Sonali?
Yeah, when you take a look at those growth concerns, you see it in the market. Certainly, you're looking at the S&P starting the day lighter on the day. You're seeing a little bit of a risk-off tone here in the United States, Dani. S&P futures down about 0.2%, just under 0.3%. You are also watching a little bit of a tick up in yields. The two-year yield up about 2 basis points at a 4.89 handle. That is about where we were a week ago. So a lift in yields, a little bit of a bond sell-off. That lift in yields feeding through to the dollar. King dollar. This is a level, the Bloomberg U.S. dollar index, at the highest level since March of this year. Higher for longer, despite the concerns about divergence among central bank policies. We'll keep an eye on that dollar all week. And Brent crude, a little bit of softening now, down about 0.6%. This is an area where there has been a little bit of volatility. Earlier, we had seen about an 89 handle. But again, Brent crude down just a little bit on the day, Dani.
Yeah, it's pretty remarkable to look at the risk-off session that's taken hold of the global market, Sonali, because on the surface, it should be a good news day. We're going to get into all these things, but things like Country Garden paying down a U.S. dollar-denominated bond, things like Goldman Sachs upping their forecast for the U.S., you think that we'd have something of a risk rally. We're not getting that. As soon as the European session started well underway around 8 a.m. is when you saw this sell-off taking hold. Now, some of the data hasn't exactly helped. I mentioned the producer prices, the fall there basically in line, not as much when it comes to the month-over-month figure, but we also had services revised down. So what do you get? You get stocks down 0.5%. You get all the high beta currencies. They've been crushed so far this morning. Cable weaker by about 0.7%. The Aussie dollar, we did have an RBA decision. They don't do anything as expected, but this is falling with the likes of Brent, for example, Sonali, with the likes of the Kiwi, Aussie falling 1.33%. So some of that European data not necessarily showing up in the market action, but it does add to the gloom. To go through all of that, we did have consumer expectations for the euro area inflation inch up in July, still well above the ECB's 2% target. Let's get over to Bloomberg's European correspondent, Maria Tadeo. Maria, we're on countdown for the ECB decision. Talk us through the numbers. How's it stacking up?
Well, I know I am. Look, the European Central Bank is in a very difficult spot, and this decision coming up on September 14th will be a very difficult balancing act, because you yourself, when you're running through all the different data, you could see that the data points at times contradict each other, but also contradict some of the statements that the European Central Bank also made just today. You had Philip Lane, who said on the medium term, he believes that core inflation will come down. He also said that there was now some evidence that goods inflation, services inflation is moving down. And then almost 2 hours later, you had that report that came out from the European consumer inflation expectations, which measures just really the pulse of the European consumer and where they see prices going. And you saw that on the 12-month basis, it was unchanged. But on the 3-year horizon, it actually picked up. So that is the wrong direction in terms of what the European Central Bank wants to see now for that monetary policy decision, which, as you say, could be a hold or a hike. What the European Central Bank wants to see is that inflation is moving on a sustainable path to 2%, but also, and this is key, and we've heard it repeatedly, that the transmission is strong enough, is operating well enough in the economy that it would lead to a pause if there was a pause coupled with the delicate state of the economy. If not, that rate hike in September would still be up for play. And some of that commentary echoed by the Belgian central banker, who today said perhaps a bit too early to rule out a hike, but again, it will hinge on the date. I think this is one of those decisions where we will really have to wait until that decision day to clarify those doubts. It's very hard to read the way they want to go.
Talk through some of the regional differences here, because we're looking at key data coming out of France, out of Germany. And are you seeing real differences in the way that the economies are heading into these key decisions?
Look, I think we used to see big differences between the services economies and the industrial economies. Obviously, we know that the German economy is in a very tough spot. We know that the Chinese downturn could really affect the German economy. We've seen for months now, this is, well, not a secret in terms of the implications of the energy crisis that had in this economy, that the industry, the German industry, it is in contraction and it is in pain. What is changing now is that a lot of the services that used to offset that are also moving in the wrong direction. They're moving in contraction. I think if you look at the PMI's numbers, it reflects that. So not only you're seeing a weakness that is spreading, but also that perhaps shows services will not come to the rescue to that manufacturing downturn. So a lot of this painting a picture that would show, again, as the European Central Bank says, that there is weakness in the economy that could lead to more downside risks for the European economy in the back end of the year.
Yeah, it is also rare to get that revision down for so many different regions for services, that sort of trend. Maria, thank you so much.
Very
it's
good
Bloomberg's
point.
Maria Tadeo. All right, we're going to go from Europe to China. And also, thank you, Maria. Thanks for the compliment. I heard it. Europe to China. As Chinese developer Country Garden avoided its first default, it had a last-minute U.S. dollar coupon payment. Let's get over to Rebecca Chung-Wilkins, Bloomberg Asia government and politics correspondent. So there we go. Finally, avoiding default, at least for now. Rebecca, what's next?
Yeah, it has been this month of will they, won't they default for 30 days, but the firm there telling note holders apparently that they have paid within that grace period and therefore averted what would have been their first official default. Now, Country Garden isn't really out of the woods yet, and if you look at the bond pricing there, 13, 14, 15 cents on the dollar, you can see investors pricing in a very low rate of recovery, actually. There are 4 more bond maturities that Country Garden will need to deal with. And there is another coupon payment actually also due this month. So the firm still needs to raise about $500 million US. The fact that they struggled so much just to raise $22.5 million to avert default on these 2 dollar coupons doesn't necessarily bode well, does suggest there's still going to be some excitement around whether or not they can continue to pay. The other thing to watch next is September is going to be a very, very busy month for other private developers that, like Country Garden, have so far avoided default. It is a hefty maturity wall, $1.5 billion US that they need to pay in onshore and offshore debt just this month. It is the biggest maturity wall that these 16 developers that have so far avoided default will have to raise this year.
Speak more to the stresses in the property sector. Is there anything the government can be doing to stem more of that stress that's under the surface?
Well, we have seen this sort of raft of measures to try and support the property sector, including in some of China's bigger cities. Now, that was welcomed by investors. It has been called for, and some really have said it's really overdue. We are yet really to see some of that support actually showing through, for example, in data, services data, and so on. And for many property firms, the big concern is whether we see this stress that so far has been relatively contained, particularly when it comes to defaults in the private sector, whether that starts to sort of spread into the state sector. Now, we had a significant jump in the number of state firms, property firms, that said they might struggle or have warned of some kind of profit loss for the first half. Obviously, it still looks like it will persist into the second half because we haven't had any kind of real bazooka property stimulus so far. But the question is whether they can then move into a phase where they actually start consolidation. That's the ideal end goal for Beijing, is for these big state developers to come in and help support these smaller defaulters.
Well, I gotta say, Rebecca, it seems like all of those concerns are undoing the rally we saw yesterday. Rebecca Chung-Wilkins there, thank you so much for that. Now, from China to the U.S., Goldman Sachs now sees a 15% chance the U.S. will go into recession. That's down from 20% as a result of cooling inflation and resilient labor markets. Joining us now is Bloomberg Markets reporter Valerie Teitel. Valerie, Goldman typically has been a bit more optimistic than than most economists out there, but this is starting to feel like a lot more optimistic.
Definitely. This is now the second time in just 2 months that they've revised down their chances of a U.S. recession in the next year, now down to 15%. And if we look at the Bloomberg consensus, it's 60%. So they are a lot more bullish than the consensus on the trajectory of the U.S. economy. And I think the difference there is that many other economists are citing these risks that the consumer is going to run into in the fall, especially when it comes to the fact that we have the student loan forgiveness done by the Biden administration that rolled off on the 1st of December. So that's going to be a headwind for the consumer as we head into the third quarter. But the reasons why Goldman made this change to their forecast was based on last Friday's labor market print, that almost Goldilocks print that the Fed got. We are seeing this cooling in the labor market. It's not falling off a cliff, Dani. It's just cooling slightly. And we're seeing that progress on wage inflation with average hourly earnings now running the lowest they have in over a year. So those are the reasons for the change in Goldman's call, but there still are some risks on the horizon as we head into the third quarter.
And before we have some key data to watch into next week when we look at CPI and other key data points that will tell us the future of the U.S. interest rates, there's still a lot this week. Valerie, what are we looking forward to in terms of eco data and conversations coming out of the Federal Reserve?
Yeah, exactly, Sonali. There is a few things on the calendar this week. It is a light week when it comes to data. We do get ISM services tomorrow. We also get the Fed's beige book out tomorrow as well. But I think a lot of the attention is going to be on the Fed speak. We have the blackout period beginning on Saturday. So this is really the last chance for those Fed speakers, especially those voters, if they want to, change the narrative slightly in the market. This is their last chance to do it. A lot of the attention is going to be on whether we see a kind of echo of Powell's Jackson Hole speech, where he really said that they need to see some sort of economic weakness before trusting this deceleration in inflation. Do we see those same kind of comments from those 8 Fed speakers later this week? That is what the markets will be watching.
At least their last chance to do it on the record. Valerie, thank you very much. Bloomberg's Valerie Teitel. Okay, coming up later this hour, we're going to be catching up with Henrietta Pacquement, head of global fixed income at Allspring. But first, up next, Chevron LNG workers in Australia threatened to go on strike as early as Thursday. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London, alongside Sonali Basak in New York. Chevron liquefied natural gas workers are threatening to strike as soon as this week at 2 major export plants in an escalation of a dispute that threatens global fuel supply. Bloomberg TV spoke exclusively to Chevron's president of midstream about the risk of strikes.
We're committed to find a solution there, and we want to find a solution that's a win-win-win. We want to find it as a win for Chevron, a win for our employees, and a win for the gas markets.
Colin, let me follow up on that, just to give our global audience some perspective on how heated the rhetoric is. This is a quote from the Offshore Alliance when they made a statement. The log of claims will ultimately be claims which Chevron will agree to, but not before they lose a few $1 billion, judging by the form guide, which is okay, as Chevron clearly have plenty of loose change in the Chevron piggy bank. Do you have any timeline as to how quickly you're willing to resolve the standoff?
No, so I mean, if I go back and really just to kind of repeat what I said before, there are active conversation, there's active dialogue going on at the moment. So I'm really not going to comment on things that are around the edge, but to say that, look, we're really committed to find a solution here, and we want to find a solution. And we understand solutions. You have to get a space that's a win for various parties. So we understand that it has to be good for our employees, it has to be good for us, and all of that will be good in the LNG market. So really, that's what we're committed to do.
Chevron's president of midstream speaking with Bloomberg's Manis Krani and Yusuf Gamal Din. Joining us now is Bloomberg MLive editor Eddie Vanderwalt. Eddie, I was prepared to talk about nat gas. it's down. Brent is down. All the high beta stuff is down. I mean, those strikes don't seem to be what's moving things here. It's almost, what have we decided yesterday was just a make-believe day? It didn't count?
Yeah, absolutely. Look, there's a lot of negative news in the market at the moment. Those strikes, I think they won't matter for the near term for Europe. But I think if they drag on late into the winter, at the moment, Europe natural gas, supplies are very well stocked, something like 92% full at the moment. So but as we get late into the winter, if we can't replenish, then maybe some Australian gas will have to come in. As far as the high beta, the market generally turning much more sour. I think on the PMI numbers from Europe, those have come in significantly below expectations. Now, there is this sort of weird moment in the market where there is good news, bad news, or is it not? I think the fact that services in particular coming in below expectations, I think that really matters for people.
You're also seeing the bond sell-off really continue into the U.S. as well as the stock sell-off. Talk about what that data really means for the global risk-off story, especially when the real bid you're really only seeing is in the dollar.
Yeah, absolutely. The dollar is the big mover here, and I think that's been the case for the last year or so. When you see the dollar up, you generally see markets broadly down. What's interesting about the yield curve is that we are seeing more of that steepening at the moment, right? I think as long as it's steepening where we're seeing the long end lifting, so if you're seeing that kind of bear steepening, then I think that is actually really good for broader markets, because that means that we're not having a spillover, we're not seeing a recession that's forcing the Fed to cut rates at the front end. And I think therefore the steepening, particularly at the back end, probably helps the market more than anything else.
Believe it, though, Eddie? Aren't we about to get a bunch of corporate bond issuance? Are we not just trying to adjust for that?
Yeah, there is absolutely a risk that we reprice all of this. And this is what happens when you're in a data-dependent world, isn't it, right? If you're without forward guidance, that means that every new data piece that comes in has to move the market so much more. So I think when the Fed says data-dependent, it is also saying heightened volatility.
All right, Eddie, thank you so much. Always a pleasure to have you on. Eddie Vandervalt there with the Market Roundup. And for more excellent analysis from Eddie and the team, and Live Go is where you want to head on your terminal. This is Bloomberg. This is Bloomberg Surveillance, the early edition. I'm Dani Berger in London, alongside Sonali Basak in New York. Now, some of the stories that we've got our eye on this morning with a little bit of deal flavor to them. Starting out with CVC. It's said to be nearing a deal to buy DIF Capital. It's an effort to grow its range of offerings ahead of a potential listing. Infrastructure manager DIF has around 16 billion euros of assets under management, according to its website. The deal announcement, Sonali, could come as soon as today.
We're going to stick with private equity because we have Thoma Bravo. It's said to be near a deal to buy NextGen Healthcare. The health record software firm NextGen had drawn interest from several other buyout firms before these talks advanced with Thoma Bravo, according to a Bloomberg source. The deal announcement could come as early as this week, Dani.
Now, over in Hong Kong, shares of skincare brand L'Occitane are falling by a record 28% in the pre-market session after the chair ends talks on a potential deal to take the firm private. Now, the company said in a filing on Monday that the controlling shareholder has decided not to proceed with the transaction. But, Sonali, there was no reason specifically for that decision.
And over in the IPO world, remember that investment banks are working on ARM's IPO, and they're said to be sharing upwards of $100 million in fees from the listing. Bloomberg is learning that ARM Holdings will pay 2% of the $5 to $5.4 billion it's seeking to raise in the public offering to those banks. Now, long-awaited set of fees for a drought that has been the worst IPO drought, Dani, since 2009.
Yeah, and that makes me wonder, Sonali, just how much is at stake with this IPO. Finally, we're going to get the mega IPO coming back to the market. But if it's a flop, does that just kind of cement then, Sonali, okay, maybe it's still not the time. We're still not yet in a place where you can exit via going public.
It's interesting because you have already seen valuations come down meaningfully. You had SoftBank at the floor by buying its ARM stake out of the SoftBank Vision Fund. Now you also have ARM lining up its biggest customers, Apple, Nvidia, to be as strategic investors for this IPO, yet you're already seeing expectations starting to be a little bit muted relative to where we were a week ago. They're seeking to raise $5 to $7 billion, but that could end up in the range of 50 to 54 billion in valuation. Remember, SoftBank bought that stake at a $64 billion valuation. And so already, remember, super sensitive time in the market. You're watching CPI data ahead. You need to get these capital raises really in before you start to hit choppy markets potentially from that economic data and any adjustments here of rate expectations.
Yeah, that's the thing, right? SoftBank just had such lofty expectations for ARM. And we're in this moment where it's almost like the market is about to issue a verdict, and the verdict maybe doesn't look as lofty as it is. But Shonali, the thing that we can potentially hang our hat up on is that maybe we'll finally get some stability. Sure, maybe rates will be high, but I got to assume that if they do plateau, we're not in a volatile rates environment. That at least has to be a little bit more friendly for some of these markets, for bringing companies to market, for raising funds, that sort of thing.
And remember, investors are starved here for new deals when it comes to IPOs as well as bond issuance. You're also not only seeing the IPO market ready to come back in a little bit more force, you're also seeing bond issuance this week. We were talking about corporate bond issuance on the investment grade side coming back, and also leverage loans to the tune of about 15 billion. Now, that is not much compared to prior years, but it is certainly welcome for investors that are looking for some yield in this market that has been starved of deals.
I was going to say, today is the day historically when we get that bevy of corporate bond issuances. So something to look out for and something that might continue to hit duration. Speaking of which, coming up, we're going to be speaking to Henrietta Pacquement, head of global fixed income at Allspring. That's next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know for the day. More fresh data trickling in as the ECB officials ponder whether to hike or to hold next week. Europe's services data was weaker than forecast, and while consumer inflation expectations inched up. Meanwhile, over in China, disappointing data adds to concerns for the country's recovery. Bloomberg economics say China may never overtake the United States as the world's biggest economy. And Goldman Sachs gaining confidence in the United States. The bank now seeing a 15% chance the U.S. will slide into a recession. That's down from 20%. I'm Shonali Bassick in New York with Dani Berger in London. Dani, what is Europe looking like today?
Well, Shonali, you'd think that after rally yesterday, we could maybe keep it going. I mean, we had good news in terms of Country Garden repaying some of its dollar-denominated bonds. You had Goldman Sachs upgrading their view of the economy. However, with the U.S. online, it's decided that we can't make any decisions without it because all of that has been undone. Perhaps we decided that the China rally was too far overgone, that the Europe data was bad. So you have a drop of about 0.1% in European stocks. But all the high beta FX, this is where the action is really taking place today. Sterling, it's off some of its lows, but still moving lower about 0.6%. Euro also looking weak this morning off the back of services data that was revised down, and otherwise were other places disappointed. Finally, Aussie dollar, that's down by 1.25%. This really exemplifying, Shonali, just the risk-off high beta kind of move that we're seeing at the moment.
There's certainly more risk-off over here in the United States as well. You're watching a little bit more of that sell-off taking steam in the U.S. You're watching the S&P futures down about 0.2%. That is a little bit better than what we saw earlier today, but we'll see how the market opens. The two-year yield, though, gaining some steam with that bond sell-off. We're now at 4.90, up about 2 basis points. We're looking at that two-year yield. We're also talking about the dollar because the dollar is really where the bid is in the market. That Bloomberg U.S. dollar index at the highest levels since March. Brent crude still facing a little bit of pressure there, down about 0.5%. Looking at an 88 handle there, $88.52, Dani.
Yeah. I mean, and I know, Shonali, that at the same time, you've also got your eyes on equities, a new call out from Mike Wilson's Morgan Stanley.
Yeah, absolutely. He's sticking with those late cycle winners like industrials and energy over consumer discretionary and small caps. He writes, quote, markets are now expecting a meaningful reacceleration in growth that he thinks is unlikely this year, especially for the consumer. To talk more about that, we're going to talk to Henrietta Pacquement. She's senior portfolio manager and head of global fixed income at Allspring Global Investments. great day to talk about bonds. You're watching those worries about growth really filter through the market here, watching that bond sell-off continue into the United States. How much more pressure are you expecting?
So yeah, we've still got this tussle between inflation and growth. I think we have had some weaker data, particularly out of certain geographies. I'd say Europe and China in particular. We saw the numbers today. But even in the US, with some of the employment numbers that came out on Friday. So I think that is a consideration for the market, particularly as risk assets have had a bit of a good run and are pricing in a sort of soft or no landing at this point. So I think it makes sense. On the rate side, well, inflation is still a thing. We're getting stickiness on the services side, and you are getting a bit of movement on the commodity side as well. So still something to look at.
It's certainly still a thing. Also, I love that phrase, by the way. It is absolutely a thing, Henrietta, especially in Europe. And it's this push and pull. At least you can kind of see it play out on the front end of the German curve, really stuck around 3%. Which is going to win out more, that inflation stuck in a range or growth that keeps coming out weaker? Where is the next breakout for the front end of the German curve going to be?
Well, I think the ECB is in a tricky spot at this point. Yes, we are sort of seeing this turn in terms of numbers from a growth perspective. But inflation is higher in Europe than it is in the US. So that does put it in a tricky situation. I mean, if you look at Christine Lagarde, she's at pains to say that they are data dependent. So it'll be really interesting to see what they do later on in September with the more information that they will have between now and then. I think it's very finely balanced as to what they do. 375, 4%. They're probably in the range that they want to be in at this point and not have to hike too much more from here.
Yeah, I would say she's almost at pains to say nothing. I feel like she seems very concerned about, showing her hand either way, whether it's hawkish or dovish. Does that mean that ECB speak, maybe we kind of put that to the side and it's all about the data that we need to be trading around?
I think you need to look at the data. I think you need to see what's coming in. I think it's not just the ECB, to be fair. I think it's the Fed as well. But the ECB is in a slightly trickier situation with maybe a little less flexibility than the Fed at this point.
Now, Henrietta, I want to talk to you about the Goldman Sachs call a little bit about the U.S. recession odds, down to 15% from 20%, because Jan Hatzius had argued the following, that real disposable income looks to reaccelerate in 2024 on the back of continued solid job growth and rising wages. And second, they still strongly disagree with the notion that a growing drag from the long and variable lags of monetary policy will push the economy toward a recession. Do you share his view, or are there risks that he's wrong?
Well, I think it's an optimistic view, but then you look at what's happened since the beginning of the year, the US economy has surprised. The consumer has been a lot more resilient, and a lot more willing as well to spend the sort of nest egg that they built up during COVID. We'll have to see if that continues. I do think that, yes, there are some after boosters, what Goldman Sachs mentioned, but also some of the investment packages that have come out in the US. I'm thinking the IRA, for instance. So there are reasons for optimism. But there is a lag. We have had a pretty aggressive rate hiking cycle, and that does leave traces. We are getting towards the end, maybe as well, of some of the COVID savings. There's the change as well in terms of student repayments. So it's not as clear cut, maybe, as they think.
As far as the equity side goes, it's been very hard to kind of argue the bull case this year, but there are expectations that there are certain catalysts that could make the rest of this year somewhat choppy. How choppy do you think that this year could get?
I think that's right. Equities have come a long way, and also you have to remember that the bond world has come a long way in terms of yields. So it does have a place in the portfolio more so than it has in years gone by. So diversifying between bonds and equities at this point, we think makes sense. It gives you a bit of an option on the growth side, but if growth does disappoint, which is an option, you've got a bit more protection if you've got some bonds in your portfolio.
Henrietta, I'm not even ready for the rest this year. I'm still trying to get through this week. I mean, this is the day, right, where we get all this corporate bond issuance. I think it was $35 billion on the Tuesday after Labor Day last year. What are you expecting this time around?
So there is a seasonal aspect to September. You do expect more bond issuance. We're certainly seeing that on the investment grade side. We're expecting that to hit on the high yield side as well, possibly on a relative basis more on the European side than on the US. So this has got a degree of normality at all. Maybe it's accelerated ahead of some potential volatility later in the month. That could be what we're seeing at the moment. But issuance went well last week. Books were well covered. There is some selectivity from investors. So different issuers are having to come with different new issue premiums. But so far, so good. And there is cash to spend in the investment grade portfolios, in the high yield portfolios, in anticipation of this new issuance.
Does that mean some calls of high yield's demise are a bit too premature at this point?
High yield's an interesting one. Yes, if you are concerned about the economy, it's one to treat with care.
Right.
And what we've seen with investors so far is they've focused on yield, particularly on the short end. Maybe now it's an interesting one to sort of lengthen out, get a bit more protection from a duration perspective. We need to keep an eye out in terms of the refinancings on the high yield side. A lot of short-dated bonds in high yield. Probably one of the highest ratios on the European side between 1 and 3 year in terms of maturity. We need to see how that gets refinanced over the next little while.
Allspring's Henrietta Pacquement, we thank you so much for your time and your analysis. Coming up next, we're going to talk about big tech bracing for the European Union's biggest antitrust crackdown. We'll discuss that next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London alongside Sonali Basak in New York. Big tech is bracing for the European Union's biggest ever clampdown on anti-competitive practices, which may invoke a new wave of legal battles between regulators and Silicon Valley. The announcement on which tech platforms are to be targeted under the EU's Digital Markets Act is due by tomorrow. For more on this, let's bring in Bloomberg's EU competition reporter Sam Stolten. Sam, I feel like I've been hearing about this for a while, and finally we're going to get something concrete from it, but catch everyone up. What exactly is the objective of these new rules?
Well, yes, indeed, it has been long in the works. The Digital Markets Act effectively aims to stop at source some of those anti-competitive practices that big tech has been accused of, particularly here in the EU over the past couple of decades. Now, the rules don't actually come into play until early 2024, but a really important development is happening tomorrow when the European Commission lays out a list of those services that will face the new restrictions.
Who will face the new restrictions and what will they have to do to fight them?
Well, effectively, that's the announcement tomorrow. There are quantitative thresholds that certain core platform services, as they're called, have to meet in order to be designated. So we can have a general idea about the types of services that will come under the scope. A number of Apple services, for example, are expected to meet the thresholds required to come under the Digital Markets Act. And that will mean that, for example, in the future, iPhone users may be able to download apps from outside of the Apple App Store, and indeed they will be able to download them from other online platforms, such as potentially the Google Play Store on iPhones. Elsewhere, if Meta finds that some of its social networking services, like Facebook and Instagram, come under the scope of the new rules, then it will have to ask users before it combines user data before those types of before that will take place. So a lot of these services are still to be designated tomorrow, but that's really the list that we're waiting for.
Yeah, I mean, Apple has been such a gatekeeper there. It would feel like such a change for me to be able to log on to the store here and download something from Google. Look, Sam, before we get to any of the enforcement of these new rules, could there be any legal challenges?
Potentially, yes. And I mean, if any legal challenges do come or any form of legal wrangling over these new obligations and prohibitions, they're likely to come relatively soon, not too long after the designation process tomorrow. And it will really centre around what platform services some of those big tech gatekeepers believe should be designated, and maybe where the European Commission disagrees with those decisions. So, for example, one company that has been relatively robust in saying that it doesn't think some of its services should be designated is Microsoft. Microsoft says that Bing, for example, is too small a competitor to Google to be designated under the new rules, and that's despite Bing likely meeting some of those quantitative thresholds to be designated. So there's lots of legal wrangling potentially in storm in response to some of these new rules and restrictions. But on the other side of things, the parts where the platforms will comply with the new rules will require quite a lot of re-engineering of some of those core digital services that have become a concrete part of our everyday lives.
Yeah. Sam, thank you very much. That's Bloomberg's EU competition reporter, Sam Stolten, in Brussels. Now, over 3 years ago, millions of office workers were sent home at the start of the pandemic. Now companies are still struggling to get them to return. That's the focus of today's Big Take. A great piece. Joining us now is one of the authors on that, Bloomberg's Irina Engel. Irina, this is so fascinating because looking at some of the differences per country, I gotta say, it makes America seem so antisocial that Americans just do not want to return to the office and see people.
Well, it's right. Just as we have national dishes, now we seem to have different national flavors of returning to the office. The US is lagging Europe and Asia in the return to office push. Only half of Americans are back in the office compared to over 75% in Europe and in the Asia Pacific region.
Why the differences? Why is it that Americans don't want to be back?
Well, it's two things, actually. It's culture and the way cities are built. If you look at China, where you have very high rates of office attendance, that's also where you have the 996 culture, which involves working from 9 a.m. to 9 p.m. 6 days a week. Also, loyalty to employers is more steadfast in places like Japan and South Korea, say, than in the US. And workers in Europe and Asia are more concerned about missing out on social connections with coworkers than Americans are. And finally, it all comes down to your home setup and your commute. European cities are more walkable, and office areas are connected to vibrant communities. By contrast, in the US, offices are more isolated and dictated by zoning laws.
So for places like the US, what does it mean for commercial real estate?
The picture is not looking great. McKinsey estimated that pandemic shifts could erase as much as $1.3 trillion of real estate values in big cities around the world by 2030. And now the value of being present in the office in different cultures is directly linked to property values. So landlords in countries where work from home is more popular are the hardest hit. Office-heavy areas of New York or San Francisco have suffered steeper declines in real estate demand alongside lower rates of office attendance. And that's compared with cities like Paris and Munich or Asian cities which value being in the office more.
Our thank you to Bloomberg's Irina Engel on a very widely read story today. Coming up, a look. Oh, actually, no, wait, Dani, I want to talk a little bit more about this story. Because this is post-Labor Day holiday in the United States here. Not only am I back, but something funny about the United States, about people coming back into work, is that you have the big banks saying, come in, everyone's needing to be back 5 days a week. Interestingly, though, their clients had a work from anywhere August. A lot of the big private asset managers, which means that today, right now, you and I are speaking to people that are being dragged back in, that have not been in New York, let alone the office, for 3 or 4 weeks.
Look, I kind of do feel for a lot of people because obviously, Chanel, you and I have been in the office for most of the pandemic too, let's be honest. But look, if you were someone whose work gave you that flexibility, and let's say you were in New York and then you say, hey, I'm going to go move out somewhere in Connecticut, somewhere that's a 2-hour commute, because work is letting me do that. For some of these firms that are changing and saying, actually, we want you back in, it's extremely difficult. You can see why some people are saying, if work asked me back in, I would not go back in. All those surveys show that in America, that problem is especially acute. And again, it gets me back to the thing that, again, in this big take, America literally comes off as the most antisocial country in the world.
Well, you and I are very social for what it's worth. And, you know, the thing is, it's your point that in the suburbs, rents are very high in the biggest cities, so people have moved to the suburbs. And, you know, there have been some companies that set up offices there, but not everybody. Anyways, coming up next, we're going to look back at the market. There are a lot of events to watch throughout the week, and it is going to be a busy week despite being a short week. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Dani Berger in London with Sonali Basak in New York. A quick look at what's ahead. Get you set up for your trading week. If today's your first week in the office, like it is for Sonali, welcome back, everyone. So we're going to get several eco releases between now and Friday. That's going to be including U.S. ISM services, China trade data, and German industrial production. Then on Wednesday, it's the Bank of Canada. Officials will meet on interest rates, and we're also going to be getting the Federal Reserve beige book, and we're going to hear from Fed speakers throughout the week. That will include New York Fed President John Williams, who will participate in a moderated discussion at the Bloomberg Market Forum on Thursday. Sonali, this one's really important. Williams doesn't speak a lot, and when he does, he's very influential. He's very influential at the Fed, so I'm looking forward to this one.
Yeah, so am I before that blackout period. We're going to look at stocks as well in pre-market trading in the United States. I wanted to show you what VinFast was doing because we're talking about new issuance, SPAC sentiment ahead of the ARM IPO. You are finally watching some cooling in VinFast. This is a SPAC that had taken this electric vehicle related company public and shot it up so fast that it had gotten a market cap that was worth more than $4, Dani. You are watching some of that excitement start to seep out of the market after Labor Day. It is down more than 9% on the day today so far, pre-market.
Yeah, I mean, our Oliver Crook was just over at the Munich Auto Show. There was so much excitement about Chinese automakers, and especially if you're competing in a region like Southeast Asia, like Vietnam. I mean, when BYD is pricing things really cheaply, it's hard to see how you can compete.
I want to focus on another area of global competition. Let's look at the chip makers. Let's look at the semiconductor industry. Let's look at NVIDIA, because after a big really rise in the stock, we've seen so much excitement. We are watching a little cooling this morning amid some global competition. You're looking at the stock down 0.8% pre-market.
Yeah, here's the good news, though, from Goldman Sachs. Peter Oppenheimer, Sonali, says that AI isn't a bubble and the rally can continue.
I also want to focus here on Blackstone because you're watching S&P inclusion for the biggest asset manager in private markets. Remember, they're going to join prior to trading on September 18th. You're watching Blackstone stock up more than 4% pre-market on the inclusion.
Sonali, I'm going to be honest. I just have thoughts about your next stock. So get to it. You go.
Okay, I'll be quick about it. It's Man U. We all chose this. We added another stock for you. It's Manchester United. Shares are dropping because there is a lot of concern that this deal is uncertain and that the Glazer family, might take the club off the market, according to a report by the Mail on Sunday. So you're watching that down more than 9%.
Yeah, so heartbreaking. And I just want to say, I do live in London. I'm very close to being a British citizen. I do watch football. And Man U had a crushing defeat from Arsenal on Sunday. They had the lead 2-1. It was declared offside. Then Arsenal comes back in the last few minutes and puts 2 in the goal to win 3-1. That is my football TED Talk for the day. Thank you for coming.
You know, I am with you for the next 2 weeks. Maybe I start watching more football with you and we make this a daily thing.
I love this idea. I love it.
Well, that does it for us for early edition surveillance this morning. And surveillance is ahead with Tom, John, and Lisa. This is Bloomberg.